Hello, my name is Ben Weiss, and I'm a reporter at Fortune magazine. Welcome. Fun to start off the day as the first panel. But I thought before we get into it, that we just kind of go down the line. Everyone would just introduce themselves. And let's start with Anthony.
Hey, everybody. I'm Anthony Moro, CEO of Provenance Blockchain Labs. We are a developer in the blockchain space, working in the Provenance blockchain ecosystem, really helping builders fast follow what Figure technologies and Figure markets have done on blockchain. And for those of you who don't know, the guy sitting next to me is Nick from Figure. He'll explain more, but Figure has become the largest issuer of real-world assets on any blockchain anywhere. And I'm sure we'll talk a lot more about that.
Great. Nick Carmi, great to see you all. Like Anthony said, I work at Figure Markets around the exchange, the ATS, the broker-dealer, and our newly launched Yields stablecoin, which is the first SEC-regulated stablecoin based off a certificate. We aspire to be the exchange for everything from equities to ADRs to digital assets and everything else in between. Work very closely on and off with Anthony and his team on what they're doing on the blockchain as well.
Thanks, Nick. Good morning, everyone. My name is Jerald David. I go by JD. I'm the president of Arca. Most people know Arca for their asset management arm. We're one of the oldest and most established digital asset managers, having first incorporated and investing dating back to 2017. I joined the company very early on and have spent most of my time working on regulated solutions using blockchain technology. Arca Labs was the first firm that actually created a 40 Act fund that issues its shares as digital asset securities. We did so with a treasury portfolio, and it ties in beautifully to what we're going to talk about here today, which are what's commonly being referred to now as real-world assets.
Cool. So I think let's get into it. So, I mean, we're talking presumably about Yieldcoins, and I think as a reporter, one of the newsiest things to have happened vis-a-vis Yieldcoins over the past couple of weeks has to do with legislation and Congress specifically. So Brian Armstrong, most people probably know him, the CEO of Coinbase, he came out and said that the definitions of stablecoins in current congressional legislation for stablecoins actually precluded Yieldcoins. So I wanted to get the panelists' takes about I don't know, maybe speculate why that definition currently exists, and then what would happen if yield-bearing stablecoins were included as part of that congressional legislation. So I don't know. JD's nodding the most vigorously, so I'll go with you.
Great. Yeah, so I mean, the first thing that comes to mind immediately when you think about that statement is, kind of the classification of the actual asset itself. And when you start thinking about things that are deriving yield, you start thinking immediately about securities. And if you're thinking about securities, the question ends up being, looking at both the two acts that are being proposed right now in DC, you start questioning what is the regulatory oversight going to be of a stable token. And the regulatory oversight of a stable token seems to be falling in both categories under the OCC, which is not under a federal regulator for derivatives or for securities, which is where you would find something that's deriving yield. So you generally expect the SEC to have oversight of anything that would be in that vein. So I think that really when you're trying to understand whether or not you're talking about a yield-bearing stable token or you're talking about a stable token in general, which would have the properties essentially of being backed one-to-one, in most cases by cash reserves. And this group obviously will recall that the original definition of a stable token included three different flavors, one of which being commodities, and there's gold-backed stable tokens that are out there right now. The second of which were algorithmic, and those failed miserably, as we all know, through the Terra Luna debacle. And then the final one obviously would be a cashback or reserve-backed stable token. So I think, again, answering the question, I think you've really got to look at what the federal regulation and the oversight really is there. And I think that in most cases for a stable token, we're talking about OCC. In things that are driving yield, you're talking about an SEC-regulated one.
Go for it.
You're spot on. I mean, our stable coin is based off an SEC-regulated certificate from the 1940s. So it's one-to-one backed. You earn the interest on it. We pay SOFR minus 50. The difference between, a lot of clients have been asking, like, hey, I can have a different stable coin that's paying me 425, for example, versus 495, which is what we pay as of today. The difference is that we don't have management fees, for example, right? But you're spot on in terms of the, anything that pays interest, unfortunately, in our current regulatory construct is defined as a security, which is what led us to working with the SEC for 2 years on yields, YLDS, which is what we call our stable coin. It is a certificate. It's peer-to-peer transferable. You can buy it and sell it 24/7. Right now, it's primarily on Provenance, which Anthony is going to help us dominate at some point in time, hopefully very soon. You get your interest. Interest is accrued daily. It's paid monthly. It is pure interest. There's no funny. We don't pay rewards. We don't pay anything. You get actual interest, just like you own a bond. The reserves are invested at one of the top U.S. banks, are invested in 3-month securities and overnight repos, very much similar to the way Circle and others do it in their money market funds. The one thing I want to just say, and Mike Cagney, most of you probably know who he is, says that a lot, and even before I joined Figure, it resonated with me. And I worked at Circle for a couple of years, and I love Circle and had a good relationship with them. And I still do. You trust what the other stable coins are doing. And what Mike Cagney said, you don't have to trust what we're doing. You have to believe is the truth, because our product is regulated by the SEC, and we are obligated to continuously offer it on a one-to-one basis. It will never depeg. If it does, Figure Certificate Company, which is a company that issues yields as a stable coin token, will get in trouble with the SEC. And all the reserves have to be invested all the time in order for us to be able to meet our obligation for paying interest to our clients.
So, just to kind of cut in here, and maybe I'll turn it to Anthony kind of as the next response to the question. So, presumably, right, when we're talking about the legislation, right, and the definition of stablecoins, there's a bit of a regulatory moat that I think Circle and probably Tether want to create for their, respective tokens. But obviously, they probably see a threat, right, from yields or from yield-bearing stablecoins, because a lot of Circle's actual money comes from just reserve yields, reserve interest that they get from holding treasuries. I guess I'm curious, like, Anthony, because you're working with Figure, when do you see, and do you see kind of yield-bearing stablecoins, eventually kind of cutting into that moat, or is the moat too big?
The moat definitely isn't too big. They're first movers, and they offered wonderful products, but their time will come, because any company that's as profitable as Tether or Circle isn't long for this world. The margins will get taken down. The Genius Act and the Stable Act are big steps in the right direction to getting ubiquity of stablecoins. Unfortunately, what we're going to see is hundreds of issuers of stablecoins over the coming, we already have hundreds right now. We're going to see hundreds more over the next couple of years. None of those will be able to distinguish themselves, so they won't compete with USDT or USDC. The yielding stablecoins, I think, will. Again, the issue with a yielding stablecoin, as we've just heard, is whether they're done in money market fund or face amount certificate structures. They're securities, which means KYC. So everyone who owns yields has to be KYC'd. Why? Because you need to send them a 1099 INT. Anyone who owns Arcoin also has to be KYC'd, I imagine, because you need to get investor docs and dividends paid and taxes paid on the dividends. So that's the distinguishing factor. But what we've seen develop over the last year are several RWA vault type products. Now, what is an RWA vault? It's a sort of regulatory arbitrage construct, and some of the more popular ones are OpenEden or USDM, USDE, DEUSD. These are all RWA vaults. So securities go into the vault, KYC'd, proper securities. They're held in custody, if you will, and through a Bermuda or Cayman or Switzerland jurisdiction, they issue out the backside an accretive token. So if we do this with yields pays 4% interest on the year. Someone puts $100 in, that $100 at the end of the year turns into $104. The yields token still stays at $1, but what's called the X yields token grows to 104. So it's an appreciating coin as opposed to a yield distributing coin. And you can then make the argument through the local regulatory arbitrage that it's not a stable coin. And now for the first time I can use it in DeFi and I don't have to KYC people and I can go cross chain and I can make it ubiquitous. So this is the battle that's being fought right now in the crypto land. And some are getting rewards, some are getting other benefits from this. We'll see where it plays out, but we're circling around the right construct. The ideal construct is a non-KYC'd movement of money because cash, right, is not KYC'd, but you don't get interest on it. So you need to find the right construct to get freely flowing. You can do whitelists of wallets, or you can just tag wallets that you know are bad, but you're never going to get perfection. You do want to get yielding stablecoins and have them ubiquitous.
Do you want to, you have your microphone?
Yeah, I mean, I think that what Anthony's bringing up here is something that's really interesting and it's worth boring down a little bit further on. So what Anthony's really saying is that there are regulated funds that are out there. The regulated funds are being operated the way that the SEC would see so, but there's a backdoor, and that's the term that he used a second ago, that allows for folks to utilize them in the ways that they think they can. I think the question that's being brought up here, and I think that everyone looks at that and says, well, what's the regulatory clarity and how will both Genius and Stables affect that? And when you look back at the way that regulation is written, it would actually prohibit that from happening, right? Because now what you're talking about is, first of all, from the issuer, because there's control on who the issuance is actually going to be issuing it. The second part is obviously liquidity, which is stating that it's going to be redeemable or transferable in a way that's prescribed. And the third part then is, kind of what is that, oversight or that governing body. So this is a paradigm within the space, I think, that really is something that folks can't figure out right now, and is something that I think is going to be getting a lot of attention over the next 12 to 16 months.
But I mean, if you're talking about regulatory arbitrage, right, obviously the regulator will soon become aware of it. And it seems like the only ability then to probably get a yield-bearing stablecoin, to be non-KYC, because I think that's the big thing, right? If it's KYC, then it's not going to compete with a USDC or USDT. Like, I feel like the regulator will always be playing catch-up there and then issuing regulation to kind of stop that from happening.
I mean, it's not real regulatory arbitrage per se, right? I mean, it's like you're setting up an offshore hedge fund and you have investors coming into it, and that fund invests in US securities and in US products and open account. There is no regulatory arbitrage. You're still following the rules that are governed by the regulator in the US, right? You're just managing them in a different way, right? And there's, if you look at our yields product, and Anthony described it very well. You have to be KYC to own the interest, but in other words, you don't need to be a client of Figure Certificate to do this. You could be a client of any exchange, as long as we have reciprocity in terms of KYC AML with the exchange or the custodian and whatnot. And a lot of them have been very open to sharing that information with us, as long as the clients agree with them. And the reason why we need to know who the clients are, so we can pay you the interest. Right? If I own a certificate now, I can give it to you, and you can do it whatever you want, but because it's under my name, I will continue to earn the interest on it, and you will not. And then the minute we change the ownership from me to you, all back-end interest will come to you. So it's a pretty cool product. It sits between a stable coin and a bond fund, for lack of better words. It's not a tokenized money market fund. It's not like Biddle, where they have a money market fund and they create a token and they invest in the token, which is Bermuda or Cayman Island based, which is regulatory arbitrage, by the way. That's if you want to call it that way. So, yeah.
And I'll just add, most large holders of money are KYC'd, and they're fine to be KYC'd. If I'm opening a treasury account or I'm a client of Coinbase, I'm KYC'd. If I'm a PayPal user, I'm KYC'd. So most of where I see USDC and more USDC than USDT, I think there's a lot of emerging market holders of USDT who don't want to KYC themselves. USDC is a different animal. I think the vast majority of USDC holders trade on a crypto exchange, and they're all KYC'd. If it's used for collateral, everyone will be KYC'd. If it's used for payments, most will be KYC'd. If it's used for cross-border remit, some or most will be KYC'd, and that's really the...
But Anthony, I challenge you on that one, right? Because right now, Ripple's reporting that 93% of the use cases of stable tokens are for payments, right? And if that's what we're talking about right now, that's 93% of the entire population of stable tokens that 93%, wow. So Ripple says. So if that's the case, then that's going to be a problem if we're talking about non-AML KYC'd participants moving forward.
Wow.
I mean, and again, going back to kind of the moat that Circle and Tether have created, right? You know, what's also stopping them from launching their own yield-bearing stablecoin? And I mean, because they have such market capture and such a big brand name, one could see that, you know, okay, maybe they're behind the 8 ball of Figure and Provenance, right? And kind of everyone who's trying to experiment on this realm, but like they may, you know, in the same way that Meta, right? You know, they released it, or they like, you know, had Reels after TikTok, but they're still able to capture a lot of attention from their users. Like, I guess I don't know what you guys think about that in terms of maybe they're behind the 8 ball, but maybe they will still capture the market of yield-bearing stablecoins because they have such a big name.
I mean, Circle's kind of doing this already with the points or the rewards that you get if you hold USDC on Circle. On a Coinbase, you get points, and points are dollars. So they're doing the same thing. Again, regulatory arbitrage.
So I think it boils down to, you know, the two different camps. Do you want to be regulated or do you not, right? And I think that's really what it is. Because at the end of the day, I think the interest-bearing stable tokens that we're talking about, and you'll notice there are words like a yield coin that evolved originally, you're stopping seeing those, you know, kind of vaults, as Anthony is calling them, calling their products yield-bearing. You're stopping seeing them called yield coins. My suspicion is that some sort of a regulator started sending some notes around and saying, you guys got to be careful with what you're calling this. And I think that that's the appropriate place for regulation. But I think there's always going to be a place whereby, you know, folks are going to want to adhere to regulation. They're going to want to, you know, be doing things in the right way. And then there are other use cases. And the other use cases may be cross-border remittance. Well, cross-border remittance obviously has to have AML KYC because you've got massive implications. But payments, right? Using a stable token to buy a cup of coffee. Like, that's not something that really should require AML and KYC for somebody. So I think that's where the divide is going to be as we start moving forward and starting to understand how this plays out.
I mean, look, KYC has been an issue for a long time. Right? I mean, back when the Treasury Department started being very restrictive on the banks in the late 90s and the 2000s, and you know, you open a bank account, you have to be KYC'd, and then you go to another bank and you have to be KYC'd again. Why isn't there reciprocity between the banks? Because there is no trust.
That's right.
Right? And I think that to me is the biggest problem in the market in general. How do we create a trust-based KYC product? Right? Maybe for the US market to start with, where if you're already KYC'd, you can take your credentials and you can freely go whatever you want. Right? That's the issue. It's you know, if look, Tether and Circle, they dominate. There is no doubt about it. Between the two of them, they $225 billion worth of stables that they issue, and I think the last number I saw, trillions of dollars worth of money movements every day, right? Which is phenomenal. Yes, if they start paying interest, which, by the way, in the Genius Act, if you read it, there is a clause in there that there is a proposal that they're considering allowing under the Genius Act to pay interest in some form or shape. I don't know if that will pass. It will be an amazing feat for anybody providing a stable coin, right? We view our stable coin, again, we're in between a stable coin and a bond fund. Right, so you can use it either way. You can use it for collateral. You can use it to buy your coffee, but the restriction with buying your coffee is that now once you paid the barista $5, which is expensive by the way, but I'd rather go to McDonald's for $1.67, which is a better coffee.
Did you pay with yields?
No, you can't, not yet, but we're working on it.
And you're partnering with McDonald's, right? To buy coffee.
But excuse me. But Nick, to your point on, you know, interest, the Genius Act, when they're contemplating interest, the Wall Street lobby has been so adamantly against that, as you know.
The banks are going to hate it. I mean, yeah, of course. I mean,
If you take it to its logical conclusion, and I have a 4% yielding, you know, account on a PayPal type app, I don't need a bank, right? And I know this is controversial to banks, of course, but right now the flow of money is I keep most of my money in my checking account. It yields nothing. Some of my money I move into my savings account. It yields a little bit more. And then if I'm a corporate or a big business, I move it into a treasury account, which might come close to that 4%. I don't need any of that payment flow if I've got a PayPal type app in my wallet that yields 4% on every dollar I hold all the time. That's existential to banks over a long period of time.
And I mean, I think it is an interesting question, right? Like, cash isn't KYC, but we're not earning interest on it. I mean, maybe there could be an argument just not to KYC like cash-like instruments that earn interest. I don't know. And I mean, obviously there's a lot of regulatory risks for doing that, but that's kind of where you guys are going, right? Where it's like a little bit of an implication. It's like, well, if it's basically cash, if we're just kind of reallocating that interest from treasuries back to the consumers, why not just have it not be KYC? I don't know.
Look, we talk about KYC as it's an issue. Yes, we need to fix KYC, but the big, and Anthony and I were talking about this earlier, the issue is interest, right? You're running funds. You have to invest in the financial markets 9 to 5, Monday through Friday, and you're limited. When is the money coming into the bank, and when the money invested, and you missed your deadline. Shit, I got $100,000 and I can't invest it, so for one day I'm missing out on interest. It's a treasury nightmare, and the banks and the financial services, they figured out how to operate in that construct. How do we break that construct? Like when Anthony tells me I want to be able to provide my clients with the ability to earn interest on a daily basis, and I want to pay them interest on a daily basis, I love the idea, right? But then the back end has to be able to produce what Anthony wants to be able to give to his clients. So there's a lot of restrictions that we have to overcome.
Right, but Nick, I think you have to go back to the evolution of why stable tokens are even here to begin with, right? And we think back your days at Circle. I mean, the main reason why they're there is because there were limitations of U.S. banking, right? That was the issue. The issue was that digital assets travel on a blockchain. You can facilitate that transfer a lot more freely and a lot more fast than you can do a banking wire. So stable tokens came into play for two reasons. One, because you needed to facilitate that fast speed of payments. And two, in order to operate exchanges, you needed a trading pair that wasn't a US dollar. And that's why stablecoins came into dominance at that point, and that was the main reason. So we start thinking about the reason why, and we start talking about 9 to 5 banking hours. Well, 9 to 5 banking hours don't work, right? There are implementations right now of payment systems that are going to come to market very, very soon that are going to be a combination of both yield-bearing instruments as well as stable tokens. And the main reason why a stable token needs to be adjacent to that platform is because you don't have the banking rails that permit that flow outside of US banking hours, 9 to 5 and on weekends. And this industry, as we all know, is a 24-hour industry whereby you've got flows coming from different geographic regions, and there are certain elements of the digital asset space that are requirements in order to advance the financial system.
But we're still restricted. When Anthony complains to me that, hey, I tried to sell something on a Saturday and I wanted my dollars and I couldn't get my dollars out, that's the problem. Because you're still limited, you still need to walk around with dollars and be able to go and pay with dollars. I think we're not there yet.
Well, what about like Signet and Sen? That permitted you to actually transfer.
Well, it does, but
banking
again,
hours.
it's limited. It's limited to a certain set of clients that are part of that network. Not
Correct.
everybody part of that
Fair.
network, right? It's like, it's a network effect.
Yep.
That's just,
Say
say something about that. You were complaining to me about it before over there.
I'm going to publicly complain about this.
No, but about the general notion.
It brings up it's a good point, kind of like what you guys are talking about, because it's not just banks and crypto companies, et cetera, adopting either stablecoins or yield-bearing stablecoins. There also has to be a buy-in from these big consumer-facing businesses that would allow it. And I think that obviously there are whispers of people, stablecoins are a much bigger and buzzier topic than they were even a year ago. Are you seeing any movement on this end in terms of big consumer-facing companies potentially kind of experimenting or thinking about using stablecoins, either on their back end or with their actual customers?
I'll go first. Absolutely. It's not only consumer companies, but if you take a step back and look at and I was reading an article 3-4 months ago, the shipping industry is huge, right? And most of the payments in the shipping industry are based off dollars, believe it or not, right? And there is a consortium now working with the largest shipping providers to create a stable coin specifically for the shipping industry. So you don't have to wait multiple days to move cash around in the world when you are in Japan or you are in the Pacific and for the US. And that's huge. But then it's a network effect.
But is it and then this is a question for you guys, right? Is this adoption mainly crypto companies, stablecoin companies, going out and doing BD, pounding the pavement in terms of trying to get buy-in, or is there organic interest from some of these companies in stablecoins or yield-bearing stablecoins?
So, I think you can break it up into two different camps, right? So some of the stablecoin activity, and this is more specific to offshore US, you're seeing, are in places whereby you've got, let's say, currencies that are being devalued, and they're basically, individuals are buying stable tokens as a proxy to actually, kind of a proxy as a hedge for things like inflation, hyperinflation, or currency devaluation, right? And I think that those are really important things that we've got to consider. The second place, obviously, is when you're dealing with cross-border payments, right? And you're dealing with things like trying to create efficiencies in transfer, while also doing so in a way whereby you're not breaking the bank in terms of paying, 20 or 30% of the actual value of the amount that you're transferring and trying to send across as well. So I think that these are different use cases that exist that are out there right now, whereby when you think about how users would adopt it, right? How people could actually use this in their day-to-day basis that you're looking for. Circle's done an exceptional job of creating partnerships around the world. And when Anthony talks before about how Tether and Circle, will be around for a long time, the main reason for that is because they've taken their technology and they've taken blockchain and they've driven it through partnerships with the different entities that are out there to facilitate the utilization and the use of their actual asset. Now, one could take that same argument and they could say that's the reason why some of these tokenized treasury funds, like BIDL, for example, although I think it's amazing that BlackRock is in our space and has taken this step, but the question you would ask yourself is, why is it that there's only 30-something wallet holders of this asset, yet they've got $2 billion worth of AUM in their fund, right? So, the main reason is that I think the lesson that we've learned over time, over the 6 and 7 years that we've been doing this, is that you can't simply take a digital asset and just drop it out there. And maybe this is something you guys are learning with YLDS, is that you can't just drop it out there. What you need to do is you need to create a use case for it, and you need to go ahead and give a bespoke and a front-to-back solution to the marketplace in order for them to adopt it. And I think that as you start seeing these deployments coming forward, I think you're going to start seeing a lot greater utilization in both the digital assets that we're talking about here, as well as the stable coins that I think are adjacent to them.
Anthony, do you have, or you want to say something?
I was going to say you were spot on about BIDL. I mean, and probably of the 30 wallet holders, I would assume it's an 80-20, where 20% of those holders own 80% of the reserves, most probably. Right. And
I think the answer, Nick, is that a large number of them are these guys that are doing the vault type activity that Anthony was describing before.
Oh yeah, 100%. Yeah, absolutely. And look, the BIDL, when they launched BIDL, the biggest issue they had was, you can only redeem it versus dollars 9 to 5 Monday through Friday, and then they struck a deal with Circle where you can redeem it versus USDC, because if you look at BIDL invests in a money market fund that invests in similar product as the Circle money market fund of one.
The BlackRock Reserve Fund.
That's right. So it's the same. It's basically like bypassing the dollars. The bigger issue that we haven't spoken about. Yes, KYC is important. Remittance is important. The biggest market in the world is the currency market, right? Other than US dollar stable coins, nothing else exists. I mean, nothing meaningful.
Well, I mean, that's a good point. It's like I think there was even a story today. I don't know how reliable it is, but like the head of finance or the financial, I don't actually know what the name is in Italy, was like one big kind of threat to the euro is actually stablecoins, because there's such a huge adoption of US denominated stablecoins, but not euro or not yuan in China or the yen, or et cetera. And I think that's it could be a potential growth for the industry too, but it also could be maybe there's no interest in using them because the US dollar is so strong.
Yeah, and just to back that up, I mean, what you see now is 99% of all stablecoin token transactions are done US dollar denominated, but 85% of all transactions globally for FX are not US. 40% SWIFT transactions are not US, and 60% of global FX transactions are not US.
What's your source on this?
He came prepared. Then I asked the
I don't know.
and you and I did not collaborate on that FX. That's very cool.
Wait, what is your source on that?
That is, I don't know the citation on that, but I can get it back.
What was the stat?
It's pretty legit.
What was the stat on dollar-denominated FX?
99%.
99%. That makes sense.
99% are US dollar denominated.
I mean, it's like, I don't know the
FX. What was it?
FX is 60%.
That's a big number. That's huge.
It's a big
That's
bit.
huge.
Big delta.
I mean, look at the euro coin that Circle launched a couple of years back. I think it's like 60 million euros or something like that, give or take, right? It hasn't taken. I mean, it's just there's no demand for it.
I mean, do you think it's because most of the like actual crypto activity is based in the U.S.? Like crypto is often like a subset of Silicon Valley, so like it's a lot of the tech and a lot of the people are U.S. based, and that's where a lot of the capital is. I don't know. Maybe that's one reason for why that is. I don't know. Anthony, what do you think?
I mean, so even in Korea, they're trading in dollars, right? I mean, it's the global cryptocurrency is the dollar. Most of the non-dollars are being used for trading pairs. So if I want to get a euro off-railed, I'm going to do a USD to EUR, and then I'm going to off-ramp it. So I think a lot of the use for non-USD currencies is the other side of a trading pair. But as we've seen over certainly my career, and I spent 20 years doing ADRs, American Depository Receipts for Bank of New York, which is non-US stocks trading in the US. English and dollars are the preeminent communication and financial tool of the world, and they'll continue to gain in importance because it's just easier to have one of each. I'm not saying it's the right one, just because they're the ones that I use, but it's easier to use one, and these are the ones that the world has chosen.
I mean, this is kind of changing a little bit of tact. Obviously, just a few weeks ago, Circle filed their S1. They had a bunch of data and financial data about their business. I don't think anyone was surprised about it, but I think maybe the number is extreme. I think it was 99% of the revenue came from just interest they were earning on the reserves that were backing USDC. So when we're talking about yield-bearing stablecoins, one big thought I have is, well, big business, or the big way that these stablecoin issuers are making money is through not sharing the interest with customers and not sharing the interest with users. So if, for example, with Figure, right, if you're issuing yields, right, or YLDS, like, how are you going to make money? If you're not actually, are you taking a little bit of a vig of the?
I mean, there is the concept of a management fee. Absolutely, we're taking a spread. That's why we're paying SOFR minus 50, right? But if you would know this, I mean, to make SOFR right now, we're talking about a prime money market fund is around SOFR right now. So figure, the difference between what we're paying and what we're making covers all of our expenses.
But isn't it kind of, one could argue that it's a race to the bottom, right? You could say that every issuer of a yield-bearing stablecoin is going to undercut each other in terms of the interest that they're giving to users.
But
yeah,
the money just comes, so it's all Coinbase is earning all of that yield. So Circle's making it, but they're giving it all to Coinbase for distribution.
50%. They're sharing the distribution 50%.
But I think that the answer is that it's economies of scale, right? So if you look at traditional asset management products, you're seeing somewhere between sub 10 basis points being taken for management fees. What you have noticed is evolved within the digital asset space is that between the private and public funds, you're seeing a floor of like 25 basis points, and then you're seeing a ceiling of somewhere between 80 basis points as well. You guys, I think, are 50 basis points. Biddle's 50 basis points. This is
Biddle's 50, but you need to factor in the fees that they charge the client. So
okay, so let's talk 50 plus. So I guess the point that I'm making here really is that, kind of folks are paying a premium right now to have a digital asset delivery. And unless this industry is able to go ahead and understand how it is that that asset itself is worth it, because why would you pay money to go ahead and invest in a treasury fund that you could pay 5 basis points for, but instead now you're going to pay 50, right? So, and that's something that the industry has to grapple with, and it goes back to the point that I was saying before, is that we need to lead and we need to provide those solutions so folks know how to use these different digital assets that are out there versus simply having it as an investment vehicle.
And that's the early, so lots of things about crypto are more expensive than TradFi, and nobody really talks about this. So listing on Coinbase is more expensive than listing on the New York Stock Exchange. Asset management fees for Buildle Digital is more expensive than BlackRock's normie fund. Right. Custody, oh my God, digital asset custody is significantly more expensive than calling Bank of New York to custody your shares. So, this industry that we are in is, not disinflationary. We are fee hungry, fee pigs, if you will, in many cases. And yeah.
I didn't say it. You did.
So, quick story. We've got a couple minutes. I mentioned I was Bank of New York for 20 years, and I like to say that I'm paying for my sins in terms of fees. We had a client, I can talk about it now because they're sanctioned, Gazprom, the Russian gas company, and I'll be quick, it's a funny story, they had the process of a depository receipt was taking non-U.S. equities and putting them in the U.S. market and operating that bridge. And there was lots of intermediary fees in Russia, lots in the U.S., and then that cross-border bridge. But the depository can take 2 cents for every ADR that's outstanding on these processes. And Gazprom had 4 billion depository receipts outstanding. So once a year, and this isn't happening anymore, Bank of New York would literally press a button and turn 4 billion ordinary shares of a Russian company into 4 million ADRs of a U.S. company, take 2 cents and make $80 million, which was 10 cents of that quarter's earnings for the Bank of New York Mellon Corporation at that time. Crazy fees, right? So these are all happening in TradFi as well, and you could do that whole process. And Nick and I are talking to the Bank of New York guys, I think, later today about doing that and making it much more efficient. So there are efficiencies to be had for sure, but the places that are sticking, we're not there yet, is my point in crypto. We need to be more efficient. Right. My mantra is cheaper, faster, and safer plus. So cheaper, faster, and safer than TradFi is what makes things successful. And a lot of the real estate funds and things that you see are not cheaper, faster, and safer. They're just a digital twin. So they're not cheaper, faster, and safer. And then the plus is they have to do something new, right? Using them as collateral, perfecting ownership. So that's where we're seeing some of the buildable funds and some of the other things that are coming into usefulness. But until everything is cheaper, faster, safer plus, this industry is not going to take off. We're not going to see the trillions of dollars of AUM that we're seeing.
Do you think that there's just the floor, I guess, for, I mean, you were talking about basis points, 50 plus, right, 80 sometimes. Do you think the floor is kind of the 10 basis points that kind of is the norm for a lot of, TradFi managed funds?
Well, if you believe that all traditional funds will ultimately be digitized by 2030, 2035, something like that, the answer is yeah, they would normalize, because ultimately what you end up having is economies of scale, whereby that's what your option is. I don't think that there's a way that the market will bear 50, 60, 70 basis points. I think there will be erosion, as you pointed out before. But when you think about it from a holistic view, it's going to be that consolidation of, or actually that transformation of traditional funds into digital funds that'll drive that.
I mean, what do you think, I guess, we have about 3-4 minutes left. I'll turn it to Nick. What do you think is kind of next for yield-bearing stablecoins? Do we think that there's going to be a launch, just kind of an explosion of more of them? There are already a number of them on the market.
I think you're going to see a lot more companies coming out with yield-bearing products. Call them stable coins, certificates, whatever you want, but you're going to see more and more, because there is, I think the end client's becoming a little bit smarter, saying, hey, I'm holding this and I'm not earning anything on it. Okay, but I can hold this and I can earn something on it, and I can at any point in time exchange it for something else whenever I need to. That's what's going to happen.
Gotcha. Anthony, what do you think?
Yeah, I mean, they're just better. Stablecoins are just better than the traditional rails. They're better than ACH. They're better than FedNow. They're better than FedWires. They're better than wires. It's going to happen. They're cheaper, faster, and safer, and they add new capabilities. So they fit my 3+ mantra, if you will. How long does it take everyone to get comfortable? How long does it take the infrastructure, importantly, to get built out? You need the ramps, you need the infrastructures, you need the connections to the ERPs and the systems that everyone has internally already. So it is a change. People often talk about this industry being the rise of the internet, and I think that's wrong. I think it's the rise of the ETFs. It took ETFs 20, 25 years to reach ubiquity and be better than mutual funds and take off to the trillions of dollars of value that they have now. I think this is a 20-year process. It's not I don't think we're going to see trillions and trillions of dollars by 2030. I think we're going to see, hopefully $1 trillion. So I'm at the low end of all the projections, and I'm making my career in this. So I'm generally optimistic.
You have to retire soon.
We're working on it. But it's hard. It's hard to change finance. That's my point.
Yeah, Anthony just said something that kind of resonates, because when we set out to create the first fund that I talked about before, Arca, as you mentioned, we coined a phrase, and the phrase that we coined were blockchain transferred funds, right? BTFs. And our belief had been at that point, and I look back at some of the presentations that we had in 2018 and 2019 that we pitched to the SEC, and that was our thesis. Our thesis was that there's a logical evolution of 40 Act pooled investment vehicles from mutual funds to ETFs, and from ETFs to blockchain transferred funds, which ties back into what I was saying before, Ben, that I believe wholeheartedly that you will see that full-on transformation, and all these ETFs that are out there will ultimately have a digital delivery mechanism in them for the reasons.
When and what do we need for that? We need on-chain TA, which we're not there yet, right?
I mean, I think that you need a whole host of things, and I think that going back to Genius and stables, that's going to pave the way because we need clear rules and regulations, which is what people have been saying on these stages for the last decade when it comes to digital assets.
I mean, it also seems like that going back to what Nick was saying in terms of network effect, I think if you have that regulation, and this is me just kind of postulating, and you guys can quickly jump in, but if you have that regulation, it makes these traditional kind of finance titans, these banks, more willing to play in this game. And then that...
Well, that's the fear. The fear is that you create that's the fear. You create the regulations, and 10 years worth of work is then eviscerated because these guys come in with the might and the magnitude that they can. So yes, it would be a win for digital assets, but unfortunately, it would be a major disadvantage for the folks that have been building for the last decade.
One thing you never didn't ask, what happens when the banks come?
That's, I don't know, that's a question
That's
for you
for
guys.
another panel.
That's for another panel. Cool. Okay. Well, we're a little bit ahead of time, but it's always better to end a little bit earlier than later. So thank you, everyone, for listening. And yeah, hope you stay for the next one.